Hey everyone, welcome back to MarketSnap. Disney stock just ripped over 15% in a single month, and the chatter online is getting loud. Value investors are calling it a no-brainer, while skeptics are pointing at a CEO who openly says he's not happy with the stock either. So which is it? A once-in-a-decade entry point into the House of Mouse, or a value trap dressed up in mouse ears? Today we're putting Disney through the full MarketSnap gauntlet. The earnings, the segments, the balance sheet, the SWOT, and the valuation math. By the end, you'll know exactly what's priced in and what could go wrong. Let's set the stage. Disney is trading right around $110 a share, putting the market cap at roughly $192 billion. The stock is up about 2% this week, up over 15% this month. But here's the kicker. Over the last 5 years, Disney is down nearly 38%. That's a massive underperformance against the broader market, and it's exactly why this stock has become such a battleground between value buyers and growth skeptics. For those who've been living under a rock, Disney needs almost no introduction. Founded in 1923 and headquartered in Burbank, California, this is the global entertainment giant behind theme parks, cruise lines, blockbuster films, and one of the most important streaming businesses on the planet. The company operates through a diversified portfolio that includes Disney Studios, ABC, ESPN, Pixar, Marvel, Lucasfilm, and of course Disney+. But here's what's interesting. The leadership has changed. Josh D'Amaro took over as CEO, and he's made it clear he's not interested in spinning off ESPN, despite investor pressure. He's also overseeing a restructuring push that includes voluntary early retirement packages for longtime executives and broader cost-cutting measures. This is a company in transition, and the market is trying to figure out if the transition is working. Let's dig into the revenue engine, because this is where Disney's story gets really interesting. In fiscal 2025, Disney generated just over $94 billion in total revenue. That's up from about $91 billion in 2024 and $89 billion in 2023. So we're seeing steady, single-digit growth. Nothing explosive, but consistent. Now let's break down where that money comes from. The experiences segment, that's the theme parks, cruise lines, and resorts, is the crown jewel. In the most recent quarter, experiences generated $3 billion in operating profit alone. That's a monster. And when you look at the full year, admissions brought in nearly $11.7 billion, resort and vacations added another $9.2 billion, and retail and wholesale merchandise contributed about $9.6 billion. On the media side, advertising pulled in over $11 billion, TV and SVOD distribution licensing added nearly $3.8 billion, and theatrical distribution contributed about $2.6 billion. Geographically, the Americas dominate with over $76 billion, followed by Europe at $11 billion, and Asia-Pacific at just under $7 billion. The key takeaway? This is not a one-trick pony. Disney's diversified revenue streams mean a weakness in one area can be offset by strength in another, and right now Experiences is carrying the load. Now let's talk about the earnings picture, because this is where the turnaround narrative really takes shape. Fiscal 2025 was a banner year. Revenue grew 7%, operating income expanded 21%, and net income more than doubled to $12.4 billion. Earnings per share came in at $6.88, up from just $2.72 the year before. That's a massive jump, and it tells you the cost-cutting measures and operational improvements are starting to show up on the bottom line. The streaming segment, which was a massive cash incinerator just a few years ago, posted a 13% SVOD margin, confirming that the entertainment segment's turnaround is real. Now, the CEO has been candid that he's not happy with the stock price, and that's actually refreshing to hear. Management is backing up that frustration with action. They've committed to at least $9 billion in stock buybacks this fiscal year, which is the highest level in 9 years. That's a strong signal that management believes the stock is undervalued. Let's get into the financial health of the company, because a turnaround only matters if the balance sheet can support it. Disney ended fiscal 2025 with about $5.7 billion in cash and cash equivalents. Total assets came in at just under $198 billion against total liabilities of about $83 billion. That leaves total stockholders' equity at nearly $110 billion. The balance sheet has improved significantly from the pandemic era. Remember 2020, when Disney posted a net loss of $2.8 billion? Now we're looking at $12.4 billion in net income. The debt-to-equity ratio sits at a manageable 0.42, and the current ratio is about 0.71, a little tight on the liquidity side, but manageable for a company with Disney's cash generation. Free cash flow is where this story really shines. In 2025, Disney generated over $10 billion in free cash flow, up from $8.6 billion the year before. That's a huge jump, and it's what's funding those massive buybacks and the dividend. Speaking of which, Disney pays a dividend of about $1.50 per share, yielding roughly 1.4%. Not a huge yield, but it's growing, and it adds a nice income component to the story. The return metrics are solid too. Return on equity is about 7.9%, and return on invested capital is around 6.4%. These aren't blowout numbers, but they're respectable for a mature entertainment conglomerate that's still investing heavily in growth. Now let's break down the SWOT, the strengths, weaknesses, opportunities, and threats, because this framework really helps crystallize the bull and bear cases. Starting with strengths, Disney's biggest asset is its unmatched intellectual property portfolio. Marvel, Star Wars, Pixar, Frozen, Avatar, these are some of the most valuable franchises in entertainment history, and they feed directly into the experiences segment, which is a high-margin, recurring revenue machine. The theme parks and cruise lines have pricing power that few competitors can match. Plus, the streaming business has finally turned profitable, which removes a massive overhang on the stock. On the weaknesses side, Disney's linear television business is in secular decline. Cable cord cutting continues to accelerate, and ESPN, while still a powerhouse, faces structural headwinds as viewers move away from traditional pay TV. There's also the execution risk. The company has had some high-profile box office misses, and the restructuring push suggests there's still fat to trim. The current ratio is also a bit tight, which could be a concern if we hit a downturn. Now for opportunities. This is where things get exciting. The streaming business is still in its early innings of profitability, and there's significant room for margin expansion. Management has talked about bundling Hulu, Disney Plus, and ESPN Plus into a more compelling package to reduce churn. Internationally, there's massive growth potential for the parks, especially in Asia. And let's not forget the content pipeline, the return of Marvel to form, and the continued strength of franchises like Avatar and Frozen could drive significant upside. Finally, the threats. Disney is facing a very public legal battle with the FCC over what it calls an extraordinary assault on free speech. That's a regulatory overhang that could create uncertainty. There's also the broader macroeconomic environment. A consumer slowdown would hit the parks and cruises hard, and those are the segments driving profitability right now. And let's not forget competition. Netflix, Comcast, Warner Bros., Discovery, and the tech giants are all fighting for the same streaming dollars and consumer attention. Let's look at the price action, because the technical picture tells its own story. Disney is up about 1.9% this week, and a very strong 15.5% over the last month. The 3-month picture shows a gain of about 6%, and 6 months brings us to roughly 4%. But the 1-year picture is still negative at about 7% down. So what we're seeing is a stock that's been in a long-term downtrend, but is showing signs of a potential bottom. The recent surge suggests that institutional money may be starting to rotate back in, possibly in anticipation of continued earnings improvement and the aggressive buyback program. For short-term traders, the momentum is clearly to the upside right now. The 15% monthly gain is significant, and if the broader market cooperates, there could be more upside in the near term. But for long-term investors, the question is whether this is the start of a sustained re-rating or just a dead cat bounce in a longer-term decline. All right, let's get into my take, because this is where we separate the signal from the noise. First, a quick word on the valuation model. The MarketSnap output for Disney is a bit noisy right now. The model lands somewhere in the neighborhood of $110 on fair value, which is roughly in line with where the stock is trading today. But I want to be honest with you. The assumptions here swing the number a lot. Change the growth rate or the discount rate, and you could easily get a fair value anywhere from the mid-80s to the mid-130s. So don't hang your thesis on a precise number. The model is a rough guide, not a target price. If you want to stress test it yourself, plug in your own assumptions on the MarketSnap intrinsic value calculator on the website. Now, here's my honest take on the business. The turnaround is real. The earnings numbers prove it. 21% operating income growth, a streaming segment that's finally profitable, and free cash flow over $10 billion. The experiences segment is a cash printing machine, and management is returning capital to shareholders at a record pace. But here's the thing that gives me pause. The stock has been a serial disappointment for 5 years. It's down nearly 38% over that period, and the CEO himself has admitted he's not happy with the share price. That tells me there's something the market is skeptical about, and it's probably the long-term growth trajectory. Disney is a mature company now. The days of double-digit growth are likely behind it. That doesn't make it a bad investment, but it does mean you're buying a steady compounder, not a high-growth story. My verdict? I think Disney is a solid value proposition at these levels, but it's not a screaming bargain. The stock looks fairly valued to maybe slightly undervalued, and the buyback program provides a floor. The biggest upside catalyst would be continued streaming margin expansion combined with a strong content slate. The biggest risk is a consumer slowdown hitting the parks or the regulatory battles creating ongoing uncertainty. What do you think about DIS? Leave your take in the comments below. Thanks for watching. If this helped you think through the story, hit like and subscribe for more stock deep dives. See you in the next one.
MarketSnap brings everything long-term investors use daily into one clean, fast platform. Explore stock financials, SWOT analysis, valuation ratios, 5-year analyst estimates, and our intrinsic value calculator, built with real fundamentals, not hype. All in a layout that's simple to read and ridiculously fast to navigate. And when you want to talk investing, join Nexus, our community where investors share valuations, posts, and stock discussions, all connected directly to the data. Use our stock's intrinsic value calculator to run and save real valuations with no spreadsheets. Share your analysis and valuations with others in the Nexus community. Get daily market summaries in video, audio, and article formats. Track the market with our earnings, dividend, and economics calendar. Our homepage gives you a real-time market overview with interactive heat maps, top market movers, and major index performance at a glance. Track daily performances, discover the most active stocks, and analyze performance across different timeframes, from weekly to yearly trends, and see which industries are leading or lagging. It's free to create an account, with optional access to premium forward-looking data. Try it now at MarketSnap.com and invest with clarity, not noise. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in, and make sure to stick with us for daily updates and deep dive SWOT analyses to keep your investment strategy sharp. Whether you're navigating short-term turbulence or building wealth for the long haul, we've got the insights to help. See you tomorrow.